What's going on, my fellow wealth creators? Matty Guys here, coming at you from the Hilton Marina in Fort Lauderdale, here for the Whole Life Mastermind, put on and put together by Tom Wall. Really excited. It's going to be an awesome weekend, great networking, great education. So we're at the hotel room here, but I still want to do some content and go through another massive class action lawsuit against yet another IUL company for very, very misleading marketing practices, misrepresenting what these IULs are intended to do or what they're capable of doing, whatever. Just extremely misleading illustrations. And this is just like it's becoming a common theme. We're seeing these lawsuits pop up all over the place. It's very, very similar to the NLG or National Life Group lawsuit. I did a couple of videos on that not too long ago. Make sure you check those out, but it's very similar. And it has to do with these volatility controlled indexes or proprietary indices, whatever. All right. There's a difference, but it comes down to these very new manufactured indexes that look really, really good on paper, but do the exact opposites oftentimes in real life. And it's really sad. People are putting a lot of money into these things without knowing how they work. And it's all based on how good it looks on paper, not what it's going to actually do in reality. I think a lot of the times the agents don't even know how these things work. They just plug numbers into their system. It spits out an illustration. Here's what it's conservatively going to do, right? They always say they're being very conservative, but as you're going to see, particularly with these volatility controlled indexes, it's not even close. It's like these things are a complete and utter disaster. And here's the thing, guys, this is why I do these videos. I just want you to be careful. We work very hard for our money, right? And I hate seeing people getting taken advantage of and putting their hard-earned money into something that they don't understand, and then they just get taken for a ride. It's really, really sad. Right? These things are massively profitable for the life insurance company, and oftentimes they significantly underperform what is illustrated. And people are making long-term financial goals and plans around these things, and they're just not doing what agents are telling them that they're going to do. And that's why these lawsuits keep popping up. All right, so I want to share my screen and go through this so you can see just how crappy these volatility controlled indexes are. Yeah, it's good stuff. So this was filed January 21st, 2025. Here is the plaintiff, and here's the life insurance company, Midland National Life Insurance Company. And then here's the independent agency where I guess the agent worked, Salmon's Financial Group. Okay, now this is not legal advice or anything, guys. Financial advice, whatever. This is not to say that you shouldn't work with or that Midland National Life Insurance Company is a bad company necessarily. All right. I'm not saying any of that. We're just this is public information. I want you guys to be aware of it. If you're considering buying an IUL from a company that is involved with a massive class action lawsuit for IUL, do you think that's something that you might want to know about? Sure. It doesn't mean that you don't do business with them. You know, companies get sued all the time for really stupid stuff, but sometimes they get sued for legitimate reasons. And these lawsuits are popping up all over the place. They end up oftentimes resulting in massive settlements. And there's a reason for that. It's because these IULs and these volatility controlled indexes are actually extremely misleading. All right. So, and of course, this is at the time, as I record, this is an ongoing lawsuit. So this hasn't been settled. Maybe it'll be settled in favor of the life insurance company. Probably not, but who knows? All right. So just keep that in mind. All right. We're just, I just want you to see some of the problems with these products. Okay. So I'm not going to go through the whole thing. All right. I'm just going to go through what I think are some of the main points that you need to know about with regards to these volatility controlled indexes. All right. So as we get into it here, the defendant offered, so that the life insurance company, the agency, offered 4 different indices for this purpose. The plaintiff chose the Fidelity Multi-Factor Yield 5% ER value. Okay. So that is a proprietary or volatility controlled index, whatever. All right. Defendants offered was not what was promised as preceding policies. All right. For example, contrary to the policy terms, the Fidelity Index is an excess return index, which they're going to explain later on in the lawsuit, in the summary here. This right here speaks to just how complicated these products are. You're going to see as they start to break this down. It's not nearly as simple as agents make it out to be. These are some of the most complicated products on the market. All right, meaning only the excess return above the Fed funds rate is the index credit for the equity component credited to the Fidelity Index segment. Did any of that make sense? It didn't to me. I had to go through this, try to understand the difference between total and excess returns like multiple times. I had to go through it multiple times to really start to get an idea of how it actually works, right? They're just so complicated. The policies also promised index selections with 20 years of historical performance when, in fact, the Fidelity Index was in existence for only a fraction of that time. Here's the thing, guys. You can look this up, right? Here it is, right here. Okay, Fidelity Multi-Factor Yield Index 5% ER. So if you're working with an IUL agent that is pitching you on these crappy volatility controlled indexes, and they're showing you that you're going to get a 240% participation rate, man. Look how amazing this thing, and look how it outperformed the market or whatever. And we're doing a really conservative illustration here. See how I lowered the illustrated rate, blah, blah, blah. Okay, 240% of nothing is nothing. So the participation rate doesn't matter if the index actually sucks in real life. Not what it's doing on paper, because it looks really good on paper, as you'll see here in a second. But here's the other thing. So also the participation rate is not guaranteed. Ask your agent, is that 240% participation rate, is that guaranteed for the life of the policy? See what they say. 99% of the time, it's not. They can't guarantee that. The life insurance company can't guarantee it. 9 times out of 10, they lower cap participation rates, whatever, in order to manage risk throughout the policy. So if that's the case, then ask your agent, how is that going to affect and impact the long-term performance of my IUL? See what they say, right? These are questions that you need to be asking your IUL agent. I mean, you shouldn't, in my opinion, you really should be speaking to an IUL agent anyways. I can't stand IUL right now, just particularly the way that it's marketed. It's not the IUL itself. It's just like these things are just so misrepresented. Often, most agents have no idea what they're doing or what they're talking about. It's really sad. All right, but check this out, guys. You can actually look these up. Okay, so if your agent's pitching you this, have them pull this up, like the actual performance since its launch date. Okay, not its inception date, its launch date. That's what this is right here. See this LD? All right, so I have this. This is like, I think the entirety. Yeah, like this is all the historical performance of what it would have done had it existed at this particular time. Okay, it's extremely misleading though. When we go back to the lawsuit, the summary, you're going to see right in the Fidelity brochure that this did not account for any significant market events or disruptions. Like it was just a nice smooth ride. So when you look at this, this looks really good, right? I mean, this is a pretty strong upward trajectory for this index. Okay, but then right here, this is the actual launch date when it was live. So it hasn't even been around for what, barely 6 years? And we're gonna, this is what we're putting our money into to create all this tax-free retirement income. Right? We're dumping a bunch of money into something that hasn't even existed for this long and then has all these other problems that we're going to go through here in just a minute. But you can see right here, the index launch date, December 11th, 2019. All information for an index prior to its launch date is hypothetical, back-tested, not actual performance. That's huge. They spell it out in black and white here. Okay, based on the methodology. All right. Let's see. I don't think it says anything about the like the lack of like it's not accounting for any disruption or extraordinary events, but it brings that up in the summary. But check this out, guys. Look at this over the last 5 years. It talks about this in the summary too, but we're here, so I want to show it to you. Look at this. Over the last 5 years, what's the average annual return of this index? Over the last 5 years, zero. It's minus 0.63% average rate of return. Explain that to me. How is it that, especially when, look at this, we go to a chart of the actual S&P 500. Look at this. Go back to, what was it? Oops, get out of here. December 2019. I can't say exactly where it is, but you get my point here. Like, look how much the market has gone up. Like, it's made a massive move. Okay, so you're supposed to get this upside potential, downside protection in the market, but where's the upside potential here with this? This is trash. This thing has done nothing. And it's because it's a fundamentally flawed index, particularly when it's being used for index universal life, fixed index annuities. It's even worse with fixed index annuities. Oh my God, at least these things are, IULs are somewhat regulated, like the illustrations are, but like this is crap. This is what the index has actually done over the last 5 years. Ask your agent about it. See what they say. All right. So yeah, good stuff. That right there alone is just like, I don't, why would you ever allocate any money to that? All right. So this is just talking about, I highlighted this just to show how recent this is. Like this policy wasn't even enforced for a very long time, but fortunately, they could already see very quickly that, okay, this is not what I was sold whatsoever. The market went up pretty significantly. I got 0%. I don't know if it was 0%, but there was a very big discrepancy between what that was illustrated and what actually happened with the policy. And it clearly that the potential for that discrepancy was not explained, right? That's what's happening here. All right. So the effective date was January 10th, 2024. The face or base coverage amount of the policy is $1.1 million. That's the death benefit. Okay. Now that probably means like it's kind of a high death benefit. I don't know exactly what the how much premium they were putting in is probably not designed correctly either. But here's the thing, guys. Like IUL agents talk about this all the time. Like, oh, it wasn't designed properly. Now, I'm not going to say that design isn't important. It is, but it has far less to do with the long-term performance of the policy than what they say. Here's why. You can design the greatest IUL policy you've ever seen in your life. Guess what, though? The life insurance company can come in and change whatever they want at any time. And I'm talking about with regards to things that impact the performance of the policy, like cap rates, participation rates, cost of insurance, spread charges, whatever. They can change whatever they want. They oftentimes drop the cap rates, drop the participation rates over the course of however many years. And you have to ask your agent, if they do that, how is that going to impact my policy? That is a very good question to ask, because they show things looking great on paper, but all of these things can change. How does that impact the performance of the policy? Here's another thing you need to be aware of. Premium load. Right? The policy has a premium load, maximum of 7.5% whenever premium is paid. Now, this isn't saying that that's what they charge. That's just the maximum they can charge. But they have, if they needed to, for whatever reason, they could charge that. Okay. But either way, ask your agent, what's the premium load? All right. Because if you have a really high premium load, that is going to impact the performance as well. There's nothing necessarily wrong with fees as long as you're getting far more value than what you're paying in fees. All right. But all these things add up. Index doesn't perform the way it's supposed to. We start having a problem here. Right. So these are things to be aware of. All right. 4 index selections. The first was the S&P 500 Composite Stock Price Index. I always say if you are going to do an IUL, just stick to the S&P 500. I would never do an IUL, knowing what I know about it. But if you are going to do it, I would say keep it simple. All right. Don't mess with these stupid volatility controlled proprietary indexes, whatever. All right. So, but these are all the indexes that were offered. All right. Policy states that the Fidelity Index is a multi-asset index. All right. So we're gonna really hype this thing up as if it's this amazing diversification index or whatever. Offering exposure to companies with attractive valuations, high quality profiles, positive momentum signals, lower volatility, higher dividend yield than the broader market. All right. So this is better than the broader market because of all these things, huh? Okay. As well as, so it has U.S. Treasuries that may reduce volatility over time. All right. So they use Treasuries, cash, et cetera, to reduce volatility, which makes absolutely no sense. Here's why. And it's going to talk about this in the summary in a minute, but I want to preface it here. Having volatility control in an IUL doesn't make any sense. Why? Because we have the downside protection already. We already have the 0% floor. So why would we try to limit volatility? Remember, with an IUL, there's an options budget and it's an option strategy. Okay. And that's usually what's involved. All right. Options have a cost. The more volatility there is in the market, the higher the cost is for the options. So what that means is when we buy an IUL, we want volatility because that's going to make our options contracts increase in value much more, right? So we're going to get a higher interest credit, right? Or that's part of it anyways. It's not the whole thing, but you know, when there's a lot of, when the market's skyrocketing, we want as much volatility as we can get because we're already protected by the downside. Or yeah, we're protected from the downside. So why are we trying to control volatility? That doesn't make any sense whatsoever. All right. It said that the Fidelity Index purportedly has the most conservative investment profile of the 4 indices. Okay. Yeah. Well, as we saw, that's just ridiculous. All right. 0.63%, negative 6.63% average annual return over 5 years. That is ridiculous. All right. Fidelity Index selections have a 35% minimum participation rate. What that means is 35% participation rate is the lowest that the life insurance company can bring the participation rate down to. All right. It's not saying that they did that, but they have the option of doing that. And you're going to see here in a second where so here's where they start out. Illustration states that the Fidelity Index selection has a 120% participation rate, and the high participation selection, whatever, has 210%. So they start you out really high. But again, ask your agent, is that guaranteed for the life of the contract? If not, what has the life insurance company done over the last 5 to 10 years with those participation rates? And how is that going to impact my policy over the long run if and when they do that? Ask that question. I'm pretty confident that you're not really going to get a very good answer at that point, and you're going to not want anything to do with this. All right. It's also worth mentioning that dividends are excluded from all of these because, like all of these indexes and IUL in general, because it's an option strategy, you're not actually investing in the market. Dividends play a pretty big part in the return of the market. So it's just something to be aware of. All right. Let's see here. All right. So this is a brochure that they're talking about from Fidelity. I alluded to this earlier. All right. According to a May 24th, 2024 Fidelity Investments brochure, which was not provided to the client during the sales process, it rarely ever is. The Fidelity Index is a rules-based asset allocation strategy that attempts to adaptively allocate exposure between 3 different components here. We've got an equity portfolio, that's the equity component, U.S. Treasury notes, that's the fixed income component, and an allocation to cash that earns 0 return, which is more drag on the performance of the index because that cash is not earning anything. It's there to help manage volatility, which again, we want volatility in a product that guarantees a 0% floor. It's ridiculous. So the index has a volatility targeting mechanism that seeks to achieve annualized volatility of 5%. All right. Now, this is where they start to explain the difference between excess return and total return here. Excess return, okay, it tracks excess return. This is the equity component, tracks the excess return performance of this particular index. Okay. Oh, man. The brochure further states that the equity component level returns are computed net of the financing costs, which are set at the Fed funds rate. So there's financing costs now involved with the equity component of this index. So there's more internal costs that are not being disclosed to the client. Okay. In other words, only the excess return above the Fed funds rate is the index credit for that equity component of the index. Okay. Now, on January 10th, 2024, when the policy was issued, the Fed funds rate was over 5%, which means this index, the equity component, had to earn over 5% just to break even. So that's kind of like a 5% spread charge on this component, this part of the index. Okay. And they talk about this down here because they go through the fixed income component as well. All right. The rate was over 4% for the US 10-year Treasury note. Therefore, the fixed income component of this index had to earn over 4% just to break even. Another spread charge type of fee that's not being disclosed here. Okay. The index credits only include these returns minus the equity and fixed income break-even rates. This exclusion, the exclusion of these returns, is effectively a massive undisclosed fee. I would say so. They take the first 5% because of remember the financing costs. They take the first 5% in this particular lawsuit with the index at the time. They take the first 5% to cover financing costs of the equity component of the index. They take the first 4% for the U.S. Treasury or the fixed income component of the index. Like that's all interest that's not being credited to your policy. Whew, it's crazy. You see, I get fired up about this, but it's frustrating. You know, it's really sad to see people put their life savings and so much money into these things, and it's just these things are garbage. Defendants misleadingly failed to disclose the index segment returns were limited to the excess above equity and fixed income break-even rates. You know why? Because like I said, the agents probably don't even know how this stuff works because these things are so freaking complicated, guys. It's just they punch some numbers into their software. It spits out an illustration. They say it's conservative because maybe they lowered the illustrated rate, but they don't explain any of this and how it impacts the interest that's actually credited to the policy. Okay. Let's see. States that illustration states the 20 years of returns for the Fidelity Index and the crediting methods were historical. In fact, these returns were not historical for the simple reason that this index did not exist prior to December 11, 2019. Launch date was December 11, 2019. Consequently, at most, only 5 years of returns could have been historical. That makes a big difference, guys. All right. This was from, they're quoting it's a bulletin from the Iowa Insurance Commissioner. I don't see, oh, here it is. Look how long ago this was too. September 15th, 2014. They're quoting a bulletin from like 10 years ago at the time close to the time they filed this. All right. Similarly, this is from the Insurance Commissioner of Iowa. Similarly, some marketing materials depict charts of recently developed proprietary indices which did not exist during the illustrated time frame, but are back-tested, and hypothetically demonstrate how they would have outperformed traditional indices. That is crazy. Using these hypothetical performance charts is misleading if they directly or indirectly through subsequent representations by producers are used to project future performance and contribute to inflated consumer expectations. I would say that's pretty obvious. I think most people, when they look at these things on paper, they get really excited. They get high expectations for what's going to happen, and then it doesn't. It completely falls apart because it's based on nothing but smoke and mirrors. All right, as we continue, there's just a few more bullet points here, and then we'll wrap up. According to an article entitled Engineered Indices and FIA, which is fixed index annuities, these indexes are far worse with fixed index annuities because there's hardly any regulation around them. They've come to play an increasingly pivotal role in how index UL products are illustrated and sold. The fundamental problem with this hypothetical look-back methodology is that it can be easily gamed because the data is already known. It's like knowing the answers to a test already. Of course, you're going to do really good on the test. Well, when you already know what's happened in the past in financial markets, then of course it's going to look really good on paper. You know, like it's pretty basic stuff. All you have to do to optimize an index and index or a crediting strategy, whatever, is to backfit the data if you want to increase the illustrated performance. Volatility control is imposed and cash dilutes the positive returns of the portfolio. During a period of rapid market price increases, the Fidelity Index does not take advantage of all these significant market increases, thereby making high returns harder to obtain. Meaning this right here. It makes it harder to obtain higher returns because of the volatility controlled mechanism within the index. Like that's why I was saying earlier, we want volatility in an IUL because we're already protected on the downside, the 0% floor. So we want to take as much advantage of as much volatility as we possibly can. The backtesting simulation assumed that there were no market disruption events and no extraordinary events affecting index constituents. This was from right here in the brochure. Fidelity explained about how its backcast model works for the Fidelity Index. It says it right in their brochure, guys, that they did not account for any market disruption events or extraordinary events affecting the index. So what they're saying is all of this happens, all of this right here, all of this happened in a perfect world. No major events, no disruptions in the market, nothing. Yeah, right. That's fantasy land, guys. That's crap. Moreover, a 0% floor rate is essentially insurance against any loss. That's what I was just saying. To provide that insurance, defendants must buy options to hedge against the prospect that the value of the futures contracts that are designed to replicate the Fidelity Index do not fall in value. See how complicated this is, guys? They're buying futures contracts on the index to try and get that high return, but then they have to buy options to hedge against the value of those futures contracts going down. Oh, man. Oh, God. This is just crazy stuff. These options have a cost. Expense associated with these hedge options would result in a further reduction of the index credits under the policy. So like we were mentioning earlier, all the financing costs of the different components of the index, the equity component, the fixed income component, up to 5%, 4%, whatever to break even. And now we have an options cost to hedge against the value of those futures contracts going down. Holy smokes, guys. This is the simplicity of an IUL. You kidding me? According to an article in this particular magazine, since its inception, Fidelity Index is down 1.03%, whereas over the same period, S&P 500 is up 51.83%. Can you imagine how frustrating that is? Holy smokes. I think that's it. I'll go ahead and wrap up with that, guys. I just wanted to go through some of the main bullet points of this lawsuit to make you guys aware of the risks involved with these things. They're not what they seem. They're not what they look like on paper. All these things, look really good on paper, guys. But in reality, this is what's happening. People are getting really hurt. These policies, these indexes, I should say, are and a lot of these IUL policies, whatever, are massively underperforming their original illustrations, and it's having it has a very negative impact on people's finances. People make lots of plans, lots of goals. You know, they're promised all this tax-free retirement income from these policies, and they're making all these future plans, making major life-changing financial decisions based on false assumptions, based on paper, something that looks good on paper. But this is the reality that I want you guys to be aware of. Now, here's what I always say about IUL. Even though I'm not a fan, I want nothing to do with it, even without the volatility controlled indexes. If I was just doing the S&P, which is how I would do an IUL, I still want nothing to do with it. However, if you want to do it, just if you understand the risk, if you understand that the life insurance company can change whatever they want regarding the performance of the policy, cap rates, participation rates, charges, fees, expenses, whatever, okay, in order to manage risk, and you're going to manage the policy, and you're really, really managing expectations, and the fact that you're probably not going to get much more than you would in a custom designed dividend paying whole life policy, 0.5 point, 1%, maybe 2% if you're lucky, over a whole life policy, you want to take that risk. Be my guest. You're an adult. Do what's best for you. Okay. But I don't think most people understand this stuff. I don't think most people know what they're putting their money into with these things. That's the biggest problem that I have. All right. So I just want you guys to be careful, and I want you to make informed decisions. So hopefully this video helps with that. All right. So I hope you guys are crushing it, and I will talk to you in the next one. If you have any questions, comments, drop them down below. Any requests for particular videos, whatever, let me know. All right. And I will talk to you in the next one. To your success. Matty Ice is out.